Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Brendan, amazing to be able to speak with you again. It's been a while, and certainly, I've seen you and your company at the top of the charts in terms of performance amongst the hedge fund community. So congrats on that. That's pretty big.
Thank you.
Yeah. So we want to get your views. So
Sure.
let me start there because I read your April note, and you did, correct me if I'm wrong, but you did say you can't see any major market disruptions occurring. We've obviously had a lot of volatility over the past couple of days. Inflation has picked up much more than anybody thought yesterday. Is that not going to be a major market disruption? Because it's kind of what it's feeling like.
It's tough to say how that's necessarily going to disrupt the market. I mean, there's been this narrative over the last, several months that I 100% disagreed with. And that was that, oh, well, interest rates are low and inflation's low, so sky's the moon, or things can just go where up forever because there's no discount rate on a growth stock. And so sure, in 2000 things got out of hand, 12 times sales, but with interest rate zero, let's go 20 times sales, let's go 30 times sales, let's go 60 times sales. Let's look at Snowflake with 700 million in revenues, $100 billion market cap. Let's look at Shopify with 2 billion in revenues and $100 billion market cap. There is no limit, right? And what ends up happening is that when things are going well, people sort of backdate their thesis, right? So they'll sit there and they'll say, oh, well, look how expensive these stocks are. Let's justify it after the fact with some other factor. And that factor was low inflation and low interest rates forever. And, you just can't, you can say low interest rates forever, but there's always risk. I mean, there's not risk that, a great company goes bankrupt necessarily, but that risk could be that, they don't grow at 30% for the next 5 years. They only grow at 20% for the last, 3 of those or something. So there's always risk. Even if you're a secular grower, your growth rate might be cyclical. So, the problem you had there was extended valuations, and we're seeing that now, right? Like now everyone's turning on all these high value, super high value tech stocks and all of these super high secular winner electric vehicle stocks. And, it's really just a rationalization that brings you back to where, things used to be. I used to cover software even in 2000. And even back then, I had a fairly tight discipline that a price sales multiple equates to a theoretical proxy for a price earnings multiple. And in that vein, you would almost never pay more than 7 or 8 times. Let's say it's growing, so give them credit for the growth, look out another couple of years. You would never pay more than 7 or 8 times 2 years out earnings.
Yeah.
When you look at what we did last year, last year we made a nice pass on Tesla. The company, when people look at Tesla, they always say, oh, well, look, it was a bubble valuation. That's not true. That stock was flat for roughly 6 years while the company grew by 700%. It was amazing. People didn't realize the stock was pretty much flat. And it basically bounced between post-split, 35, 40, $40. While the company grew 700%, it's amazing that the short stayed short in the face of that kind of growth. But the entire trade on Tesla under that vein, from $40 to like 350, that's just a catch-up trade to their growth. You could argue it was overvalued in the first place, but that was just a catch-up trade to the growth. Everything beyond 400, that was valuation explosion all the way up to $900. So I never saw it as a bubble. We sold our stock as it went through $400 or $500 because, it had caught up. But, that's just the kind of thing where people got a lot of hands. So I look at it and my internal model saying 2024, 2025, they'll probably be earning $15 a share. So if they're going to earn $15 a share and slow down to 30 or 20% growth, then I'll give them 30 times earnings because it's a great company. That's $450. And 6 months ago, we were at 900. And you can see it with all of them. I think Shopify should be at 8 times sales, not 15 times sales. Great company. I would say that about almost any great company. And when I say, 7, 8 times sales, I'm talking 2 years out. Give them 2 years of growth and then reevaluate. But, it's a lot of, that's the stuff that's getting attacked right now. The stuff where the valuation was through the roof, the more value stuff, that stuff is not taking the same level of pain. But, again, you got to the point where this high value tech was 50% of the S&P 500, 50%. They say FAANG was 27%, but the reality is all of tech was pushing 50, right? I mean, you have Netflix, but what about NVIDIA, right? You have, Microsoft, but what about Cisco? These are not small companies, right? So, tech was once Tesla went in, that was another 4%. So, you had this point where the highest valuation portions of the market were half of the S&P 500. And, even in small caps, because I know a lot of your viewers might look at small caps, you had a similar situation where, you look at the Russell 2000 and, to be like the 10th company in the Russell 2000 2 years ago, you had to have a market cap of like 3-4 billion. Now, all of a sudden, GameStop is the #1 stock in the Russell 2000 at $20 billion. So, what happens to the valuation of the Russell 2000? Why did it outpace the S&P 500 by so much after 5 years of lagging? By so much, it outperformed for like, for about 3-4 months there. And that's because all of a sudden GameStop and DraftKings became the largest companies in the Russell 2000. I mean, GameStop, right? I mean, that's your largest holding in the Russell 2000, I think, right now. So you've seen this whole reconstitution of the market. So going back to your original point, I don't see the systemic risk in the market. But I see a lot of valuation risk, and I am worried. I am worried about inflation. I am actually worried about inflation. I don't know how that affects the stock market necessarily. It affects interest rates, but the inflation we're talking about, and there's a lot of controversy. There's a lot of economists say we don't think that inflation is going to be that bad. I listen to conference calls. I'm not looking at data, and a lot of data is backward looking. I'm listening to conference calls, and the conference calls, we own a countertop manufacturers and door manufacturers, and they're all saying like, yes, our costs are going up. Our costs are going up, and raw materials will be 30% of our cost of sales. And so next quarter, look for our gross margins to go down, but we're already starting to increase prices, and that's not going to show up for another quarter. It's not going to show up for another quarter or two. Those prices will hit in Q3, right? So I don't know, like personally, how much online shopping have you done in the last couple of months?
Not much. I
Not
mean,
much.
if
Okay.
what do I need?
Right. And a lot of people, you're right. And a lot of people feel the same way, but, I keep track of some retail stocks. We've made some good money on Levi's. I'm a big fan of this whole reopening, denim cycle that's going on. And, if you look at Levi's, if you look at Urban Outfitters, if you look at American Eagle, the thing you're seeing in apparel right now, and you can see it in appliances too, look at Lowe's and Home Depot. The other thing you're seeing is that people aren't giving out the discounts. The sales aren't there. Things aren't going 30, 40% off. They all tightened up inventory. And so you've got raw materials coming up, prices coming up in, industrial goods, but even in retail goods, you're not getting the same discounting. And that's a form of inflation that I don't think is showing up in the numbers either.
No,
So
that's
I
go ahead.
I have concerns there on inflation, but again, the companies are going to reap the benefits of that inflation, right? They're going to raise costs, and they may hold margin. The other big question mark is labor inflation. Labor is like half of all these companies' costs, right? You always think like a guy who makes doors or something, it's all raw materials. No, labor is a huge component. And right now, the big problem, you can hear it from Uber and Lyft, they're having to pay their drivers. You have to pay employees more because they're getting paid to stay home. And that's an issue. So right now you're paying people more to come to work, but in 2 quarters, when the stimulus checks end, all those people come back to work and the market gets flooded. And then, labor rates will probably flatline for a while, but they may already be elevated based on what's happening in the next couple of months. While it's like we've got demand, but we don't have people in order to make sure that we can fulfill that demand. So you do have some interesting factors there where you say, well, is labor going to be a problem? Because labor is a huge point. Is labor going to be a problem in 6 months? It might not be a problem in 6 months. Then inflation might not be so bad. I suspect labor will be a problem in 6 months because McDonald's just announced that they're, increasing their employees' salaries this morning. And you can't have like, oh, we're going to give this guy $15 an hour because he's here now, but the guy who starts in November, he's only getting 12. Like it doesn't. You're going to end up paying more for everyone based on the raises you gave today. So I'm a little cautious on that, but there are ways to win there.
Yeah. There are certain sectors and stocks to buy to hedge, not even hedge, but to really benefit on that potential move. But let me ask you this on the inflation front, because when we really think about the government debt loads around the world, which I know we're going to touch upon as well, because you did mention that in your April note. But they've been at this game since the financial crisis, and they haven't been able to really spur growth. So I'm sitting here wondering a lot about stagflation. So inflation and no growth. Is that on your radar? Are you concerned about that? And if that's the case, what do you invest in? And what does that really mean for the equity markets? Do you want to still own real estate, load up on real estate? What do you do?
Well, you could get stagflation. You could get no real growth. And I'll also mention anecdotally, because we're bottom up. So I listen to a lot of conference calls. And one of our biggest winners last quarter was a company who basically said, hey, we thought we were going to earn $5 a share. Turns out we're going to earn $10 a share, like just a massive blowout earnings. But when you dug deep, you said, well, okay, so what happened here? What were your volumes up year over year? And more you hear volumes were up 1 to 2%, revenues were up 30%, earnings were up 20%. The volumes aren't growing. And that goes to your point that are you not going to see real GDP growth? So do we have a situation right now where we're seeing the growth in the companies, but we're not seeing the growth in the units, and it looks like real growth, but because the inflation might be coming later, does that create a situation where the stagflation's there later, but the signs are there now, right? And so again, that's something I'm a little concerned about. Real estate is interesting. Real estate, your big risk there is do you think that at some point rates have to go up? If rates have to go up at some point, and they probably do from zero, that's not good for real estate. So you have a real asset, but you've got a real asset that's interest rate dependent, right?
Right.
So I'm going to say this, I'm not historically a resource guy, but we have put a substantial amount of our capital into the gold trade recently. And I'm not a resource guy, and I'm not a gold guy, and I'm not an anti-fiat currency guy. And my mentor is probably the most well-known guy, in North America, if not the world. But recently, I think that you could have a very big setup for a gold move above 2000. And should some of the Bitcoin investors come back to gold, you could see a copper-like move in gold. And I mean, I don't want to get too out of control, but you could see a situation where copper goes to 6 or 7 on supply and demand, but gold could go 2,500, 3,000 for all I know. Like people talk about Bitcoin being $2 trillion or something, and gold's 9 trillion. Oh, it's got more room to go. But all the cryptocurrencies put together, I think, are 12 trillion. So, you're kind of there, and you just wonder whether a lot of people I know who swap their money from gold to Bitcoin because of fear of missing out or whatever. If Bitcoin, has a check back, like the kind of crap that happens today, it doesn't look too stable on the way up and it doesn't look too stable on the way down. If these people say, look, I'm looking for inflation protected stability, and they move back into gold, there's a lot more money to move that way now, and you won't find any sell. You're not going to be met with any selling on the other side. I can tell you, anyone who's still left in gold ain't selling it. You're going to be met with
Yeah.
zero supply if you try to get back in. And I could see it. I'm not a gold guy, so I don't want anyone taking my advice here, right? I don't want anyone taking my advice. I'm just telling you what I'm doing, but I will be the first to admit I'm not an authority on the subject.
Okay, so that's amazing. Brandon, there's a lot there though. I want to go back for 1 second. Did you say your mentor in the business is a gold guy?
Yeah, I am. My first job was at Sprott Securities. I was actually Eric Sprott's associate.
Wow.
Back, I would call them formative years, but from 96 to when Sprott when Eric left to form Sprott Asset Management. I didn't go with him. I stayed to be a tech analyst, but I was there for for that for his first big move into gold in 1999. And he is the foremost expert on the space. So hopefully I grabbed some knowledge through osmosis there.
You must have. Where was that? That was before he left to form his company.
Eric was the CEO of Sprott Securities, which was a broker dealer now known as Cormark Securities.
Okay.
And in 2000, he left to. He always had a fund with Sprott Securities, but he basically broke it off to start Sprott Asset Management as a standalone. So that's really where and a bunch of us bought the brokerage operations from him.
Okay, understood. Yeah. It's pretty amazing though that you were a gold associate and then moved into tech.
Well, I wasn't. Yeah, I wasn't a gold. I mean, Eric was pretty generalist, so I started focusing on tech exclusively in like late 98, 99.
Okay.
So I still worked with him a bit at that point, but the gold call, I wasn't involved with the gold call, but we had morning meetings, we had discussions, so again, that's more of I hope stuff sunk in through osmosis rather than I was looking at gold stocks specifically. I was looking at tech, and my interaction by the time late 99 rolled around was looking at shorting tech into the tech bubble. So that was sort of a different. I mean, when he had that just unbelievable run, he was actually both short tech, like shorting Amazon at 500 and buying gold stocks when gold was at 500. Like it was one of the all-time, I got both sides of this market figured out calls.
Wow.
that he was making.
Okay, that's amazing. And it's also amazing that you are, going into gold because, for as long as I've known you as well, I don't ever think of you as a gold guy. So here we are. Since we're on the topic though, you did bring us a number of your gold picks today. Why don't we just talk about a few?
Well, I don't have a lot of gold. I mean, I have a lot of stocks in there. So gold, our biggest one was really just buying the GLDs. I mean, that's the easiest way to do it. Obviously the stocks will move twice as far. So you can stand some safer large caps like a Kirkland Lake. I mean, if I think because I think gold's going up, I don't really feel like taking the political risk. There just doesn't seem to be any point. I mean, the one thing I have learned over the years is that if you're going to bet on gold, or you're going to bet on copper, or you're going to bet on a commodity, you're going to bet on oil, you can put a little money in something that triples, you can put a lot of money in something that doubles. And sometimes it's easier just to eliminate the risk and put a lot of money in something that's going to double. Just simplify your life, get the same aggregate return, and then take the risk off because it's something a little easier. So, the gold stocks that we own currently, so we have Kirkland Lake. I mean, that's big, that's Canadian. The other Canadian one we own would be Victoria Gold. And then there's another company in Australia called Karora, which is symbols KRR. Australia is obviously pretty safe. Those are
Mhm.
probably the safest ways to do it. Or you could buy the GDX, which would be the US ETF, and I can't remember, there's a
Mhm.
Canadian ETF as well. Just be aware when you're buying the ETF, it's all Freeport, Newmont, Barrick. I mean, it's like half of the, it's like buying the triple Qs, right? Like 70%
Right.
of your holding is 5 stocks. Not
Right.
particularly risky stocks, but you know, I think if you want to play it simple, just Kirkland Lake's probably easy. And if you want to go down a little bit down the risk curve, Victoria Gold is a Canadian miner as well. It's
Mm-hmm.
eliminate all the superfluous factors. I don't do exploration. It's just too long. There's a permitting process. Maybe they get bought. You know, they probably aren't producing by the time the cycle's over. And I'm not a big fan of developing mines either, because the inflation is going to hit them while they develop. I want producers. I want cash flow. I want good balance sheets. You know, I know that sounds simple and boring, but you know, they will move twice as much as gold moves.
Got it. So that's what you're doing on the inflation protection front,
Mhm.
going long gold. But what about some of the other areas that you think will benefit from inflation?
Yeah, I mean, we're still really big fans of the housing trade. That's a big one for me. I mean, so one of the issues you're going to run into the housing trade right now is home builders versus building products guys. So home builders are somewhat susceptible to price slowdown. So their costs are going to go up. And if they can't raise price, that might squeeze them. So we've shifted to building products. So we own companies like, I'm sure everyone's heard of Caesarstone, or a lot of people have heard of Caesarstone. The stock market hasn't heard of Caesarstone. It used to be a large, well-followed company 5 years ago, and then Chinese competition and the basically knocked their margins, and then everyone abandoned it. Um, and so they're just turning it around now. And so we're really, it's a brand name, right? Like people buy quartz, they say, I got a Caesarstone counter. They don't even think of the brand. So I'm a big fan of Caesarstone. We've owned Masonite, which is a formerly Canadian company, probably I think it's the second largest door manufacturer next to Geldwin, but it's a pure play, almost pure play on North American residential. So they actually, you know, they did a study a couple of years ago that said that the one thing that people are willing to do is pay more for doors. It's just an underpriced part of people's homes relative to how much they think that they should cost. So they have a lot of pricing power. There's only 2 players, and they've both been following each other in terms of pricing. So they seem to have a lot of leeway to raise prices there, and it's impossible to bring on new capacity. Like these guys are entrenched. So that's one way to do it. So those are
Okay.
good ways to do it for sure. And also, you know, there's some apparel where, you know, inflation doesn't have to be raising prices. Like I said before, it has to be lowering discounts. So that's a reopening denim cycle. So everyone has their sweatpants. Everyone bought their 5 pairs of Lululemons last year. You know, good thing about Lululemon is it's a very high quality product that lasts a long time. You don't need to buy any more Lululemons probably for another, you know, 3-4 years. And you can see that stock has not done very well. But you know, the problem with Lululemons is that it's an elastic waistband. So unless you're stepping on the scale, you know, every couple days to check stuff out, you try on those jeans that have been sitting in your closet for a year ago, and you know, and maybe you lost a couple pounds, maybe you gained a couple pounds. All you know is they're a little loose, or or you can't get that button done up, and now you need a new pair of jeans. And so the denim cycle is big right now. Levi's is one of the top players, along with the Gap and Contour Brands and American Eagle. But Levi's is a pure play. It's a heritage brand. And
Mhm.
there's a fashion change, right? So people have gone from skinny jeans. Now you're starting to see people wear baggier jeans, and you know, and mom jeans, I guess they call them, and flare jeans at the bottom.
I'm not a mom, and I bought a pair of mom jeans, and
So
they do not look good
okay,
on me.
but that's
I'm
the
just telling
style.
you.
But that's the style. They're saying
It's a
you
higher
wear
weight.
skinny.
If anybody doesn't know what a mom jean is, it means it's just a higher waist.
And
That's
it's a looser fit.
oh. Mine
Yeah.
wasn't that loose. Maybe that
Well,
was the
some
problem.
people, some of the mom jeans are higher fit, and then they're tight around the hips, and then they flare out more at the bottom. But they're definitely distinguished. They're definitely distinction from mom jeans and skinny jeans, which are almost like denim leggings, right? So skinny jeans are still the most searched, but they're losing share to more relaxed fits, and this is like a
Okay.
new thing, right?
So
So
wait, I gotta stop you there for one
yeah,
second though,
yeah,
Brandon,
yeah.
because
Talking
I used to,
fashion, I love it.
no, yeah, well, that's why I'm stopping you. I actually used to do equity research covering specialty retail at William Blair going back to 1997 for a few
Mhm.
years, right? And I worked for an excellent analyst. He was tough on me. But he was brilliant. He could, he basically taught me to, read numbers like you would read literature. So to your point about discounting, we would go in and do store checks year over year, quarter over quarter, whatever it was. And, we would literally check how much discounting there was. And therefore you go back, you put in your Excel spreadsheet, and if they're going to beat on the gross margin or the operating profit or miss, and therefore the stock gets impacted. So he was just so great in terms of a mentor and teaching me how to do all this. But one of the things that you have to know and get right when you buy retail is understanding the trends. And so to your point about jeans, you're right. I mean, if you're right on this trend, it will do incredibly well. My question to you is, because I haven't really been following the jean trend, how do you know that this is a new trend?
Well, I mean, obviously there's a lot of anecdotal evidence among the others, but actually my ace in the hole in terms of knowing what the denim trends is I have a 19-year-old daughter. And
Okay.
I can tell you, like, her and her friends and whatever, and you can see the red tab, right? So I know Levi's is an up and coming brand among the kids who are the late teenagers, like early teenagers where your parents still influencing. You're probably still going to American Eagle to get your jeans, but for the more fashion forward ones, you're buying Levi's right now. And then for people my age or something, you're probably still going, you're still buying, like, if you're buying high end jeans, you're still buying whatever
True Religion.
Page, or like, well, True Religion hasn't been as, maybe among women, but among men you don't see as much True Religion. But the guys will buy like Page or AG or stuff like that.
Okay.
So that's but again, it's usually the younger crowd that drives this because they buy more frequently.
And so from a valuation perspective, or people understanding that Levi is a stock to own, I mean, where are we in terms of the stock price?
Well, I mean, I wish it was cheaper. I mean, we bought it, we've only made 50% on it, which, sounds great, but in the context of the last 5 months in retail, that's probably a little better than average. But in terms of valuation, so now the trick you run into is what they're guiding to and what I think is possible. So they're guiding, I mean, I can look it up right here, but they're guiding to, and the models are all saying this stock trades at, and again, this year's kind of a mess. You got easy comparisons and things are coming up, but for next year, the street thinks that they'll earn about $1.40. So it's trading about 20 times that. And then they think they'll earn $1.60. The key for me is that the company is expected to do EBITDA margins of 15%. Okay. And 15% sounds good, but their gross margins right now are like high 50s. Okay. So if you were to compare that to, there aren't too many retailers that do high 50s gross margins, right?
No.
One that happens to do high 50s gross margins is Lululemon. And Lululemon's high 50 gross margins, and again, they're all retail. Levi's is mostly direct retail, whereas Lululemon's you can only get on their website and their store, but Levi's moving a little more in that direction. But their 58% gross margins translate into 25% EBITDA margins, right? So if you go sort of like, let's look at the art of the possible here on Levi's, right? And it's tough to do. So you got to have that margin for error. So right now I'm at 20 times earnings. I'm comfortable with that on what's probably a 3 to 4 year cycle on denim. But if they can achieve 20 or 25%. But even if they can achieve 20% EBITDA margins, that $1.60 that's expected to happen in 2 years on what I think is fairly reasonable growth expectations, that $1.60 could easily be $2.20. And if people like Levi's, they say, wow, this is a brand again. This is a hot brand again. You can get that sort of brand, that premium brand multiple, that heritage brand multiple, clean balance sheet. You get another bit on that. That $2 to $2.30 a share in earnings, that could trade at 20 to 25. You could see a $50 stock. I'm not saying you will, but you could. The question is, how far do they want to push margins, given they clearly have the capability to do that, given their gross margins.
So I hear you on that, and it's always so important to kind of have those Excel spreadsheets and figure out the art of the possible. I love that.
Eric, it's funny because I mentioned it before. Eric Sprott used to call it. He said he'd get into a meeting with a company. I say it. It's a great saying. Get into a meeting with the company's like, yeah, I know your guidance and all this. Put your rose-colored glasses on. That's what I always say. Put the rose-colored glasses on. In 5 years, where are you? Not realistically, rose-colored glasses. Where are you in 5 years? I always thought it was a great way to, if you really like something and you suspect, as is the case with Levi's, and you got to lead the horse to water, and you're just sort of like, well, is 25% EBITDA margins even possible? Well, there's my rose-colored glasses if it's possible, right?
Love it. Love it. Let me ask you this though: to buy a pair of jeans, don't we have to be able to go to a store? I mean, can you really put on a?
Yeah, you can't. Well, I mean, look, people are buying them online and then return. The kids are much more into buying online and returning, like more so than I am. Like me, I buy online, and I buy online from places near me so I can walk there and return. I don't like having to go to a Canada Post thing and having to return. But it's a reopening play. So I mean, that's really what it is for me, that as the world reopens, people are going to be going there. They are going to be buying stuff there. They are still selling, right now, I think, and obviously, last quarter, we're still sort of in this COVID thing. Last quarter, they did 1.3 billion in sales. At the bottom, they were only doing 500 million in quarterly sales. That 1.3 is about down 15% from where they peaked pre-COVID. I'm interested to see what happens when the stores are all open. I do think the kids are going back to malls, because malls are a social experience for them. But like even me, like I'll buy, a dress shirt online or a pair of gloves online, or, but I won't buy a pair of jeans because I got it. The bottoms have to be, hemmed. Like, how am I going to get the bottoms hemmed? If I get, like that's like, I'm not talking about fancy tailoring. I'm saying, unless I can get the length I need, what's the point? I'm not capable of doing that myself. And so, I think the kids are more used to it. And I think I think as stores reopen, they want to go shopping. They want to be in style. Yeah.
Yeah. Well, it's interesting that they're still 15% below, the prior peak.
Yeah. And they'll all tell you, all these guys will tell you, like, we own Skechers too. They'll all tell you, oh, we're still 30% of our stores aren't open. Canada's like the worst. Europe's like the second worst. If you have sales in India, forget it. But it's always funny, these companies that are North American centric, they always call out Canada as being the worst. It's frustrating.
Okay. Well, yeah, it feels like it is a bit behind in terms of the pandemic. I think everybody's probably on the same page for that. I didn't think we spent so much time on Levi's, but I guess just with my background and talking about it is certainly helpful. So one more question on Levi, which is, how's management? What's the company management like?
The management's been there for a long time. I haven't gotten a chance to speak to them, only because, I did do a Zoom call a few months ago, but they're not very easy to get hold of. The business is still 55% owned by the family, dating back, over 100 years. They're sort of consistent 10b5 sellers of the stock. So if you do get a chance to speak to them, it's usually because, someone's holding a consumer products conference, and you can get on a Zoom call. But management's been there for a long time. They've been turning margins around for a long time. It only recently went public. Before that, we used to follow and own the debt when it was a private company. But they have recognized the opportunity of the first big denim cycle we've seen in like 7-8 years. And it's funny because they'll tell you, they'll say like, it's funny, these older brands, skinny jeans were in for so long that we used to keep these around as heritage brands, and like there were times where we were just thinking like, why don't we get rid of them? We're not selling them. And all of a sudden brands, they didn't even try, just people started going towards the relaxed fit jeans on the website and stuff, and they were like, we just had them there, right? And just people started gravitating to them. So I think that because they have so many heritage cuts that they don't have to force designs on people. They can see what's coming to them, and I think that's actually put them ahead of the curve. So other people are out there talking about the looser cuts, but Levi's was really the first one to have it, just because they happen to have all these heritage brands on the site.
Got it. Well, I mean, I love my old Levi's, and I wore them so much they're worn out.
Mhm.
And I'm talking from like a
That's a
long
look
time
though,
ago.
isn't that? That's
It's
a look,
great
right?
look. I want that really faded denim, but real denim. I don't want soft denim. I want the denim that kind of keeps just, holds you in a little bit.
You know what's
like
funny?
Real jeans.
So you
if
can
Levi's is
go.
listening, I want them to
I
make
want
me a real
jeans.
pair.
Yeah, so you can
Real.
actually go. So the new Levi's concept is actually, you can go there and you can custom the finish, right? So what they do is they'll import the cut, and then they use a laser process, which allows for faster turnarounds to create, those little, cool rips, like, big rip, small rip, the little frayed
Yes.
rips, some of the coloring, like the fading and stuff.
Yeah.
And they can do it so quickly now, whereas before they used to have to hold inventory. They're like the first ones to do this. So we'll see if that translates to sales. It bears watching, but because they only really came out with it last year, it hasn't really stood the the commercial test. Yeah. But it is interesting because it's good for their margins. It's good for their turnaround. It allows them to fast adjust to different fades and different different wear and tear looks very quickly. So you can actually go in there and you can pretty much customize a jean that'll be, in your hands in a week. Right. So they're doing interesting things. I hope it translates to us making more money on the stock, but
But Brandon, it's interesting though that that's one of your reopening trades, and it does make sense in the sense that the stores obviously aren't open yet. That could be a really nice tailwind. What other reopening trades are there? And I think part of your note as well to your investors is saying that that the stay-at-home trade is kind of done. Is that true to you?
Yeah, I think the stay-at-home trade's done. So a couple reopening trades. I think that, again, building products, a reopening trade, right? How many houses have now been bought but not yet built? The last thing to go in there will be the, Caesar stone. It'll be the kitchen counter, right? So their growth is ahead of them. The doors, the interior doors, that's ahead of them, right? So there's a lot of stuff ahead. The work from home thing's interesting. Like all these banks, even Silicon Valley, even like the most forward thinking, oh no, we love Zoom and we love Slack and everything. They're calling them back to work now. So what's actually interesting is that work environment is going to have to change, right? You're not going to be able to sit shoulder to shoulder in a crowded office hoteling situation. The cubicles are coming back. The old Dilbert cubicles, office space, they're coming back. And the place to go for that is probably Steelcase. Steelcase is historically the leader in office systems, office furniture. One analyst follows it, again, completely abandoned space. Yeah, it's completely abandoned space. Brand name, high ROE, great financial metrics, made their way through it. We actually spoke to them a couple of weeks ago. We also spoke to a large private competitor as well, probably the largest private competitor in the space, saying, you know what, I don't want to say we're going to get back to our old record levels, but there's changes coming. People are coming back to the office. We're starting to see that we're going to see some serious order flow, towards the end of this year, middle of next year. And if that stock used to be at $20 at 14 today, and I would argue that their next year could be a record year, you could see that stock make that 50% move even from here on a reopening trade. So,
what's the ticker, Brandon? What's the ticker?
It's SCS.
SCS.
Yeah, and the players in there, the biggest players there were Steelcase, Herman Miller, and Knoll. And Herman Miller just decided to buy Knoll, which is odd. There hasn't been a major expansion, a major merger in that space forever.
Yeah.
And I think there's going to be a culture clash because Knoll, a big part of Knoll's business was like Holly Hunt and Vladimir Kagan and all these sort of, super fashion forward furniture, like residential furniture designs.
Mm-hmm.
And Herman Miller had some, the Barcelona chair and a few other interesting things, but they were a little more, their bread and butter was definitely a little more focused on standard office. I'm not sure how that merger is going to pull out culturally, but Steelcase is, they're your market leader, go-to guy, Steel Eddie, sort of steady Eddie, brand name guy, strong balance sheet. And then of course the other good ones, a private company used to be public here called Technion. And Technion is they're also, they're big four now. There's going to be a big three, which is so Global / Technion is the big private company. That's a Canadian company.
But is Steelcase, I mean, what has been the majority of their revenue, their business?
They're mainly, they're probably Global Technion is like 100% office furniture, but in terms of the ones, Steelcase was probably the most indexed to office furniture, followed by Herman Miller, followed by Knoll.
Okay, so office furniture, what percentage that would be cubicles if you're saying that's kind of the big trend?
Well, you're going to need new everything. So it won't, I mean, last year they were selling like vinyl partitions, right?
Oh,
see-through partitions because people wanted to be blocked out. But, you can't just get a new desk system. You're going to need a new chair. You're going to need, all these things because what people have been building on were these sort of like, hey, look at this long sort of trough of desk and you don't have your own seat. You come and you check in and you check out and you bring your laptop and you plug. That's where everyone was going.
That open
everyone was going to,
it's an open concept office.
Yeah, open concept.
Sit where you want to sit.
Densification, right? Save on rent. And they said, now we're seeing orders for offices. We're seeing orders for glass offices and stuff, like that's making a comeback now because people, they want the privacy. They want the physical barrier now. I'm interested to see how it plays out, but I'm just pulling up the model now. But if you talk about margin of safety, right? If you look at margin of safety, here's a company that used to, before this happened, was earning like $1.70. The stock's at $14. They have no debt. They carried a return on equity in the high teens. They were a cash flow machine. They had a big dividend. Like all these things really sort of work into their favor. If they did $1.60 on $3.7 billion 2 years ago, I think they could get back to that number 2 years from now, and the street's only at $3.78 billion. So I think I got a ways to go here. So, I think that's a great reopening trade. And then I also think the ultimate reopening trade is still probably Disney. So we own a lot of Disney. That's a great reopening trade. Before the pandemic, they had only started to move to artificial intelligence, capacity and pricing at the parks. And parks are like 35-40% of their business still. So going into the pandemic, everyone thought they could earn, not including streaming, thought they could earn $8 a share, and then whatever value you want to put on streaming, which was probably costing them $2 a share. So if we just took streaming out of the equation, right? And I got to imagine that $8 probably turns to a 10 now, because prices will be higher. Parks, they'll have this AI capability in the parks. Also, they didn't have the Star Wars park opened yet. They didn't have the Avengers park opened yet. They had a lot of expansions that they never got to see at full power, right? So you're going to be talking about $10 a share in earnings plus streaming. Well, if $10 a share in earnings is worth $170, stock's $170, what's streaming worth? If streaming's worth 60% of Netflix, and I would argue it's worth as much as Netflix, it's worth another $70. I mean, I could see that thing going at $250. And then the other weird one, because we like Canadian content over here, is everyone remembers Molson beer, whatever. Well, Molson's now part of Molson Coors in the States. And that company's been very, in my opinion, poorly managed. They've lost some market share. Their margins are half of what their competitors are, and their multiple is like 2/3 of what their competitors are. But the interesting thing about Molson is they index higher to bars and restaurants. They have a greater percentage of their revenues are bars and restaurants. That's a better reopening play, I think, than than their competitors. If they could get multiple equivalents, the stock would go up 30-40%.
Wow.
If they can get margin equivalents, it could go up another 30-40%. So again, rose-colored glasses. If they can do InBev's margins,
Yeah.
right? So if they could do InBev's margins and they can get InBev's multiple, right?
Yeah.
Then, 2 years from now, on what I would consider fairly conservative, almost no growth estimates, to get to InBev's margins, the earnings per share go from $4 to $7-8 in earnings. If they get that multiple, that $7 trades at 17 to 20 times earnings. Now you're through 120, $130, and the stock is still, the stock's still at $58. So it's interesting, but if they're going to earn $4 a share, I don't know how much risk I have from 55. Someone will take this thing over, at some point if they keep, limping along like this.
I want to go back to Disney just for 1 second, though. What do you make of ESPN and what we could expect there?
Well, I think ESPN is still a really good brand. They got the best. They got the best renegotiation with the NFL when that renegotiation happened a few weeks ago. I think it's a great brand. I think gambling will help because people are gambling on all sports. So I think that'll probably help. It'll help the brand. It'll help. It should help viewership because you see a lot of sports broadcasting is now being tailored towards gamblers. The bigger concern isn't ESPN. And of course, there is some risk. Like they're trying to offset ESPN Plus, which is subscription, with cord cutting, where if you get a cord cutter, they might cut their ESPN, or they would cut their ESPN. They might not renew as a streaming service. The bigger risk is probably the cable business. That's where you start to run into some trouble there with ABC. It's not a huge portion of their revenues or valuation, but it's worth bearing an eye on. I mean, the good news is like the street's giving it up for dead. So I don't think that there's not a lot of risk if it does end up doing poorly, because that's built into expectations.
Yeah, that's what I was going to ask you. I mean, that's what really hit the stock going back. I think it's now at least 2.5 years ago when there were so many negative calls on ESPN.
And there's a huge portion of the revenues. Yeah, it was a huge part. People would look at this like, oh my God, ESPN and ABC add up to like half the revenues. I wouldn't have thought it was that much.
Yeah,
it isn't now, but it was back then, right?
But to your point, and which is always so important for stocks, is it's built into the expectations.
Yes.
That's key. And that's different from a couple of years ago in terms of what it looks like.
And that's been the problem with big tech. You could sit there and say, this is a great company that's growing at 30%. Shopify is a great company that's growing at 50%. Well, that's great. But if the street expects them to grow by 60%, you're going to lose a lot of money. If the street expects them to grow by 40%, you're going to make a lot of money. Like, Carl Icahn had this great saying I saw a couple of years ago. He's like, I don't know if it's a great saying, but he would say like, everyone knows what the good companies are and everyone knows which companies are doing well. Like the key is to find the companies are doing well that no one thinks are doing well, right? Like that's the point of the exercise. You can make a lot of money short term, buying the momentum in sort of the well-known narrative, but long term, like Tesla, it's like Tesla when we were talking earlier, $400, the earnings beat stopped. The stock still went to $800-900. You're like, why is this thing doubled in 2 quarters? No one's raising their estimates anymore. The earnings are well known. They're not blowing away earnings. It's because those expectations were already built into the stock. What the stock doubling with no expectations going up was telling you that they had to beat the expectations.
Right. But so let me actually get your take then, though, on a couple of those large cap stocks, even though that's not necessarily your focus. Apple. Google, Facebook, some of the FAANG names, can they still move higher?
Well, Apple, I don't like as much anymore. Apple's growth over 5-6 years has not been what people think it is. Like every quarter they beat by a bit, and last, they went down, then they came back up because of COVID. The biggest problem Apple has is that it's cyclical now. And it's going to cycle to its iPhone releases. And when you're cyclical, you probably shouldn't trade at a big multiple. It is a cash machine. I'll give them that. But I don't see it as a particularly interesting company right now. Google's sort of in the middle. They're trying to catch up on Google web services. I think YouTube is, people look at YouTube and say, well, that's worth as much as a Netflix. But I do find that that on YouTube, obviously the advertising and stuff is getting a little much. But YouTube's a great platform. I don't know how much further you can go and search at this point. So I'm on the fence there because I think the valuation's reasonable. And then Facebook, we own some Facebook. I think Facebook's earlier. I think Facebook's making the shift from social to commerce. And I think that's a huge thing. On Instagram, you hit the ad or whatever, it takes you right to a commerce site. They're starting to do payments. It becomes very seamless. They're integrating commerce into WhatsApp and Instagram and stuff like that. So I think that's there's a whole other leg to Facebook. I don't know about virtual reality. Zuckerberg's really a fan of virtual reality right now, but I think that even if you discount that to zero, I think there's a whole other leg that Facebook has yet to show us in terms of the commerce capability via the messaging and via Instagram and stuff like that.
Any big picture concerns, though, with respect to the regulatory environment, or is that just something that we're going to continue to talk about, but nothing actually gets impacted?
I think it's tough to do much for a regulatory lockdown on Google or on Facebook. If I'm worried about regulatory, it's more Apple. Apple is really showing itself to be something of a bully on the App Store, and they're starting to get taken to court on it. And, the argument they always had was that, for things to be things to be perfectly interoperable, we need to police it. That costs money. So we're going to charge 30% in order to do that. Right. And then the latest battle with Epic Software, which is not just their games, they're the platform that almost all the games run on. And what they were doing is saying, okay, well, we're offering for free, because Apple managed to get all of their people to offer free product and then go with add-ons where they make more money off of consistent add-ons than if you just paid $2 up front. So what Epic did was they said, well, we're going to let you buy upgrades via tokens, and you can buy those tokens anywhere. It doesn't have to be on the App Store, right? And Apple said, forget that, right? We don't want you to do that. You're bypassing our revenues. And Epic's attitude is, well, you don't provide any value once the person has the game and just the add-ons and stuff. So we should be able to do it anywhere. And by the way, you don't charge Netflix. You don't take a slice of Netflix's, $10 a month. And then Apple says, well, that's because you can buy Netflix on TV. It doesn't have to be. You can use the account in multiple places. So you have this whole battle going on. And my attitude is like, well, you remember maybe when Microsoft got slapped on the wrist for embedding Explorer for free on the operating system, and Netflix said that's not fair, right? And what you're seeing with Apple now is, just imagine if Microsoft 20 years ago said, hey, that's a pretty good video game. If you want that video game to work on a Microsoft computer, you're going to have to pay us 30% of every sale. If you want Word to work on your computer, you're going to have to pay us 30% of every sale. Like, people would, like, the Federal Trade Commission would have had a fit had they done that. And yet that's exactly what Apple's doing now. So they're running into trouble there. The whole sort of protect people's privacy, people don't know this. So when you get that little warning on your phone saying, do you want this site to track you and all that stuff, right? Like, Apple tracks you. You have to go deep into the settings menu to switch Apple's default will track you for ads to not track you. But if you're Facebook or anyone else, you have to actually you have to opt in.
Right.
But with Apple natively, you have to opt out. That's not fair. They're playing by a different set of rules, themselves. And then you've got the issue of competition.
Brandon, I'm sensing that you have found that in the settings and have opted out.
I have, but I'm more technologically proficient than probably a lot of
Than
people.
me.
And
Yeah.
you have to go deep in. You have to go deep into the setting.
Where?
Well,
I'll follow up with you.
you almost
I'm
have to.
gonna
You
look.
almost have to Google it. But
Okay.
I mean, even I don't remember offhand. But
Yeah.
I can guide you through it. But I don't remember offhand. But the other thing that you run into now is when they come up with Apple Music, right? So a lot of people have Spotify. I have Apple Music just because it's simpler. But Spotify came out in a congressional hearing and said, look, we got a problem because we got to pay royalties to the artist. They have to pay royalties to the artist. So we can charge $10 a month. So what are they going to do? They're going to match us at $10 a month. But the $10 we charge, they want 3 of that. So we got a problem now because we're only getting 7. They're getting 3 of the 10 you're spending on us. We get 7, they get 3, and then they can charge 10 themselves. Hell, they can cut it down to 7 if the economics work at 7. They're like, that's unfair competition. So I think that you could see a crackdown on the Apple App Store, and that's obviously like an 80% margin business. So I'm quite bearish on Apple. I like Google, not enough to own it. I like Facebook enough to own it. I think Amazon's probably going to have to churn through that reopening narrative working against them. But Amazon's probably one worth revisiting. I think Microsoft's a great company. They're more sort of one which I'd like to buy at a better price, but they're kind of like a Google. Like there are points where I'd buy it and stuff, but they're fairly reasonable. Like of the big ones, it's really Apple. Apple I'd stay away from for a while, and Amazon I'd stay away from for a bit. And
Okay.
Facebook's the one I own.
Got it. Brandon, this has been amazing. It's almost been an hour. I don't think I can take any more of your time.
Gotcha.
But I want to do this again and sooner than later because I still wanted to get your take on, and for our viewers to understand, you run an income fund, a founders fund, and a select fund. So you had some interesting comments in your newsletter on your expectations for yield and how to make some interesting fixed income investments.
Mm-hmm.
So that we haven't talked about Bitcoin, and I didn't even get to ask you the fact that you're in gold or in some of the commodities, that's more your inflation hedge or trade, but oil. So did you invest in oil?
Stay away from oil. I think that this is it's been a great run because a lot of things shut down and oil's cyclical. It always has been cyclical. It always will be cyclical. The question is, what's the top and bottom of that cycle? The marginal cost of a barrel of oil, marginal, not including, exploration, just sort of the cost to pull a barrel of oil that is in there today is about $25. So I don't even start getting interested in oil till it hits $30. And I'm probably looking at selling it at 70. I don't need to stick around all the way to 90, but historically you're talking about 3 to 1. So now's not the time to buy oil. Fixed income's tricky right now. Yields are horrible. Terms are too long. There's no covenant protection, but we've always been good at finding like these little corners of the bond market that can provide outsized gains without taking outsized risk.
Mm-hmm.
Right now, probably the most interesting part of the bond market is these tech stocks have sold off. They've all in the last year, a lot of them issued convertible bonds. And those convertible bonds might as well be investment grade, but because the arbitrageurs, they will sell the bonds off along with the stock. We're buying companies with 20 billion and companies that are earning money with 20 billion in market cap, $1 billion in debt, $1.5 billion in cash. You're getting a 2.5% yield, which sounds low. That's better than investment grade. And if the stock comes back, you're going to make like 15, 20%. So I'm willing to take a little less yield right now in order to have a big gain. What we say is like, look, I'd rather buy a 2% yield with a potential 25% gain than buy a 4% yield with a potential maybe 7 if it gets, if the yield compresses a bit. So that's tricky. It's very difficult for a retail investor to run those strategies. That's our alternative income fund. It's a liquid alt, so it's pretty easy to buy. Our founders fund is our other main strategy. It's a long short. It tends to run about 50-60% net long. There's option overlays on the short side. So That's one where you're really relying on our stock picking, and now sort of a bit of a macro call on gold. But that's our largest fund. It tends to do a good job keeping up with good markets and outperforming on bad markets. And our select fund, we don't normally recommend. It's a very high risk fund for high risk investors. It's not that the terms have lower liquidity. It tends to be a little more long only, but I'm not that comfortable putting people who I don't know very well in that fund, because you have to be able to handle an average of 4% a month moves, and those are, you know, that's 4% a month is a lot. So it's been a great fund. It's been our best returner, but it is high risk, and in certain high risk.
I love the fact that you say you don't really recommend it to many people.
I have to believe that someone, I mean, I have to believe someone can handle like a 30% drawdown in 2 months without completely freaking out, right? Because some people, you know, they lose that and it ends up being a life-changing, you know, amount of money. I honestly just don't want that kind of responsibility. So, you know, and so our founders fund is going to liquid alt soon. So that'll give people weekly liquidity in the liquid alt version of that fund. And that we consider our medium risk, but the select fund will always be a limited partnership. It's, you know, I wouldn't say it's invitation only, but it's kind of close to it.
Wait, Brandon, let me ask you though, for viewers who are listening to all of this, do they contact your firm directly, or do financial advisors sell your funds?
We do have some most of our investors call us directly. It's high net worth, but the liquid alt is available like any liquid alt fund through an advisor. And our Venator investment trust is also offered through advisors. That's the one that's going to be converting into a liquid alternative, which means I don't think you don't even have to be an accredited investor anymore to get into that fund. We'll still have the same strategy running in a limited partnership on the side. But these funds are going to be a lot more accessible to the retail investor once we, so the income fund's already a liquid alt, but once we turn the investment trust into a liquid alt as well, that should be in the next month.
Okay, great. So that people have access. That's always a nice thing. Brandon, this has been amazing. Can you believe that it has been about an hour and we used to try to condense like to 5-6 minutes on TV?
I know. Crazy.
Crazy. I love it.
And you're just down the street. So, I mean.
I know. Well, one day we'll just be able to do this in person.
Yeah. We'll just, you can come, we can set up in my boardroom or something.
That'd be fun. A traveling studio. I only need a good light.
There you go. And we got a painting in the back that I think's by the same photographer, or a photographic art in the back, same photographer.
Perfect. We'll do it. All right, Brandon, I'll let you go. Thank you so much. It's been amazing insight and knowledge. So thank you.
All right. We'll see you soon. Thanks.
Okay.